Welcome back. Today we are diving into a critical topic that could impact your finances significantly. We're going to talk about the changes in client marginal tax rates after the Tax Cuts and Jobs Act, or TCJA, sunsets at the end of 2025. So whether you're a financial advisor or just someone trying to navigate these complex changes, this video will break down some of the major changes set to take effect in 2026. If we haven't met, my name's VanLandingham, founder of Paresis Private Wealth Management, where we help clients design and implement ideal, worry-free retirement plans. We created this channel to help as many people as possible and equip them with the right tools and education to live that worry-free retirement. Also, don't forget to subscribe and hit that notification bell so you don't miss out on any important updates. And it also lets us know what type of content you find most beneficial. Now let's get back to the TCJA sunset and its possible impact on your finances and taxes. So the Tax Cuts and Jobs Act, passed in 2017, was one of the most extensive tax legislations in over 30 years, affecting individual, corporate, and estate taxes. Many of its provisions are set to expire, or sunset as they call it, at the end of 2025, which is just a little over a year and a half away, or actually a little less than a year and a half away. So this sunset could have as much impact as the TCJA's initial passage, which affected nearly every taxpayer. So from a financial planning perspective, the impending expiration of TCJA makes early planning crucial. Although the exact outcome hinges on the election coming up in a few months, waiting until that last minute isn't really a viable strategy. Taxpayers, clients need to start preparing now for any scenario, and you can utilize scenario analysis to see how these different provisions will impact your individual situation. So one of the biggest questions is whether your marginal income tax rate will be higher or lower after TCJA expires. And contrary to popular belief, not everyone's taxes are going to increase. Some households might see a decrease in their tax rates. So let's take a closer look at current tax brackets and compare those to the estimated post-TCJA brackets. So as you can see on this chart here, which kind of compares the two different tax rates, we've got several different brackets on the changes to those brackets from 10 to 37, where we are currently. And then if the TCJA expires, the brackets 10 to 39.6. But under the tax structure, the current tax structure, which is has the TCJA implemented, we have 7 major tax brackets, right? So we've got 10, 12, 22, 24, 32, 35, and 37. So after TCJA sunsets, these brackets will shift to 10, 15, 25, 28, 33, 35, and 39.6. So as you can see, while the 10% and 35% brackets remain the same, other brackets will see an increase of 1 to 4 percentage points. But it's not just the rates themselves. The income ranges for each bracket will also change. For instance, today's 24% tax bracket covers incomes from roughly $178,000 to $340,000 for married couples filing jointly. Post TCJA, that range will be covered by the 33% bracket, which is a significant increase. However, some income ranges might benefit. For example, single filers with incomes between $45,000 and $95,000 will shift from the 22% bracket to the 25% bracket post TCJA, but the effective tax rate may be influenced by other factors like deductions and exemptions, which we'll get into here in just a minute. So remember, it's not just about the brackets themselves or the shifts in the brackets. Changes in standard deduction, itemized deductions, and the return of personal exemptions will also play a critical role in determining your overall tax liability. So let's look at pretty much a comparison of these brackets, deductions, long-term capital gains. And you can see post TCJA, we'll see significant changes in how taxable income is calculated. So the standard deduction will be reduced, and the $10,000 cap on the state and local tax deductions will be eliminated, leading more people to itemize their deductions than currently do. So personal exemptions will return, offering a little over $5,000 exemption per taxpayer or dependent, which is especially beneficial for larger households. So first, let's talk about the standard deduction. Currently, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. After TCJA sunsets, these amounts will be reduced to approximately $7,850 for single filers and $15,750 for married couples filing jointly, almost cutting the current amounts in half. With that happening, then we also have the $10,000 cap on the SALT deduction, state and local tax. They'll be eliminated. This means taxpayers can deduct the full amount of their state and local taxes, which is particularly beneficial for those living in high tax states. More taxpayers will find it advantageous to itemize their deductions instead of taking that standard deductions if we do see the TCJA cuts sunsetted. So with the removal of the SALT cap, more itemized deductions become valuable. For instance, deductions for mortgage interest, charitable donations, and medical expenses all become more significant components of your tax strategy. This change encourages closer look at all possible deductions to maximize your tax savings. So whereas before you just take the standard deductions and it was an easy no-brainer, now there's going to be a lot more tax planning involved. So another major change in the return of personal exemptions. Before, the TCJA taxpayers could claim an exemption for each person listed on their return. This exemption was about $4,050 per person in 2017, and it's estimated to be a little over $5,000 per person when it returns. And again, like I mentioned before, this is particularly beneficial for larger households with multiple dependents. So let's break that down with an example. So you have a married couple, 2 children, they'd receive 4 personal exemptions totaling about $20,040. And this amount is subtracted from their taxable income, significantly reducing their tax liability. So larger families benefit more as each additional dependent adds another $5,000 exemption. So for single filers and smaller families, the changes might not be as dramatic, but they'll still feel the impact. A single filer with no dependents will have less benefit from personal exemptions compared to a family with multiple children. However, the overall shift will encourage everyone to reevaluate their tax planning strategies. And now we'll get to the business side of it. So for owners of pass-through businesses like partnerships, S-corps, and sole proprietorships, the sunset of TCJA means that an end to the section 199A, which is the deduction on qualified business income, or QBI. This deduction provides a 20% reduction in taxable income. However, not all business owners are affected equally. For example, owners of specified services, trades, or businesses, SSTBs, should consider deferring income to avoid higher marginal rates within their income phase-out threshold. So let's take a look at kind of the key impact here on this change, especially when it comes to the QBI deduction. So you can see here single and then the married filing jointly on the far left, and we broke it down on should they accelerate their income or delay their income, and it all boils down into, are they the SSTB, which are like your attorneys, financial advisors, or are they non-SSTB? And depending on their estimated gross income range, that's going to determine whether or not they should delay income, recognizing the income, or accelerate that income. So deciding when to recognize income is a key strategy in planning for TCJA's sunset. So for many, accelerating income into 2024, 2025 might be advantageous, especially if they expect higher tax rates in the future. However, for some, like the SSTB owners within the phase-out threshold, deferring income might be more beneficial, which can be seen in this spreadsheet that we just looked at. So given the political uncertainty, flexibility is essential when it comes to planning. You should prepare for multiple scenarios and be ready to act quickly once there's more clarity on the law's future. Are they going to extend it? Is it going to sunset? It's better to be prepared and knowing which route you're going to take. So the goal is to lay the groundwork now so you can implement the best strategy when the time comes. So to wrap things up, I know that was a lot to dump on you. The expiration of TCJA will bring about significant changes in tax rates and deductions. So as I mentioned before, early and flexible planning is key. Whether it's accelerating or deferring income, understanding these changes and preparing for different scenarios can help you navigate this transition more smoothly. I hope this video helps clarify some of the changes and their impact on your finances if the TCJA is in fact allowed to expire. And if you found this video helpful, don't forget to subscribe. I mentioned that before, but no harm in ask it again. Subscribe for more financial insights and hit that bell icon. It'll keep you updated as we post new content. If you have any questions, leave them in a comment below, and we'll see you in the next video. And remember guys, choose your advisors wisely. Your financial health depends on it.